Okay, so good morning, everyone. Welcome to the new week. We are Monday, July the 7th, 2025, recording this in the morning, as always. Coming back from the long weekend from the US, sort of Independence Day. Okay, so if we just look overnight, let's just have a look a little bit and see what's going on. Not a huge amount of news. Basically, in terms of the tariffs, we know that July the 9th, which is coming up on Wednesday, is the sort of official deadline for deals to be done with America's trading partners. And what we've got this morning, a bit of an update from sort of Trump and Treasury Secretary Bessent, essentially saying that I think letters are going out to 12 different countries. They need to come back with a deal or an arrangement, or otherwise the situation or the threat is that what Bessent was saying this morning, that if there's no deal, then they'll resort to the levels of April the 2nd, those levels announced, with the big sort of poster on April the 2nd, Liberation Day. And that will be the levels, and that will be going into effect on August the 1st. So, quite a lot of sort of threats and whatnot. At this point, we don't have a deal. The US doesn't have a deal with China or the European Union or Japan and a host of other smaller countries. The only deals which, if you could call them that, which have been announced, of course, are with Vietnam and the UK a few weeks ago. Secondly, this morning, Trump also sort of threatened the BRICS nations, so Britain, Russia, India, China, the BRICS kind of loose sort of affiliation, which is meeting at the moment in Mexico, in Brazil, and basically said that there'd been extra 10% tariffs on those as well because they're sort of anti-American. So, so at this point, we're in a situation where, the market is probably just a little bit confused because we don't exactly know what's going on. There's still no understanding really of who's going to really be sort of footing the bill for these tariffs between the sort of the exporters, the importers and wholesalers, the retailers, and the consumer. And at this point, it seems as though it is falling onto not so much the exporters, but the other three parts of the of the distribution chain. So let's see what happens today. So I think this week there's not a huge amount of data. In fact, there's very little data. So quite possibly there's going to be a lot of chop in terms of sort of tariff headlines. But what I would say, my personal perspective is it seems that in some shape or form, we are definitely getting some tariffs in the US, and they will quite possibly be at a minimum, I don't know, 5 or 6%, possibly will settle around the 8, 10, 12%, depending on which country and which industry. Now, having said all that, there's a lot of details to come. So let's see what happens, and let's see if Trump, is the taco man, and he'll sort of walk back the deals, give extensions, et cetera, et cetera. Let's have a look. Now, just in terms of what happened at the end of last week, obviously Friday was the holiday. On Thursday, we got the data. The market took that as being pretty strong data. I think I spoke about that on Friday. But the more I looked into it, there are definitely signs that you could argue that there are some sort of weak elements within, within the initial jobless claims, the continuing claims, the amount of hours worked, the fact that wages are coming down, the fact that there's massive seasonal adjustments, the fact that a lot of the sort of jobs added are actually really sort of government jobs, or maybe sort of, health assistance jobs, which are essentially an extension of government programs. So not necessarily a super strong job market. Nonetheless, the market took it that way. And let's just see. So at this point, it's looking at something like the Fed. There's not a huge sort of incentive for the Fed to do too much at this point, to do anything particularly soon. If we let's have a quick look and review this. You can see that for the July meeting, there had been some talk that maybe, a super weak number last Thursday for the non-farm payrolls would have potentially caused the pricing for a July meeting to go up. But that's off the table. It's no longer the case. And you can see here that for July, we only have a 1%, sort of 1 basis point, sort of priced in at this point, essentially 0 or 4%, as you can see here. Having said that, though, I like to look and see what's happening towards the end of the year. So if you look at the 10th of December meeting as a benchmark, you can see that the market settled down to just over 2 cuts. So still pricing in 2 cuts. So the market seems to be coming to the narrative that the Fed sort of, wants to cut. It's just looking for a little bit more data. It just wants to make sure that inflation is not crazily accelerating. And assuming that's the case, the market is assuming that the Fed will cut twice, maybe once in September or October, December, et cetera, et cetera. So at this point, we've got 53 basis points, but you can see that that's moved a little bit. So if that's 53 basis points by the end of the year. And if you look here just at the tick chart, which is very short term, each day here represents a day, you can see that the market had been going towards a more sort of dovish expectation. So at a certain point before the non-farm payrolls, if you go back to the 2nd of July, for example, we were at almost down to 70 basis points. So almost three cuts. So the market definitely there was leaning towards maybe sort of a soft number, soft metrics, and it didn't get that. So of course you see this huge push up here, and basically the market took out, let's say non-farm payrolls, let's say about 65, took out about 12 to 15 basis points. So it took out a half a cut. And so that's where we're at the moment. So I think at this point, Powell is probably saying, hey, the labor market is reasonable. We have uncertainty still about tariffs. We have uncertainty about the follow-through effects, if any, of inflation in terms of tariffs. So we'll have to see what we do, what's going to happen. And there's not a huge amount sort of happening at this point. So if we just look at a few markets, let's just have a look, let's say, for example, at the 2-year yield, which I'll just bring up, give me 2 seconds here. Let's have a look at, this is the daily chart. So let's just look at some of the yields. So let's look at the 2 years as a kind of a proxy here. And you can see here that, here's moving averages here. So between the 20 and the 50 moving average. But you can see here that had been moving down to about 3.7 or so. Keep in mind the effective Fed funds rate, it's about 4.33. So the 2-year had been, what's that, about about sort of 55, 60 basis points below the effective Fed funds rate. But as we can see here, even a little bit today, but basically on last Thursday, the last full trading day, we see that the yields here popped up on the 2-year. So at this point, I think the Fed is not going to do too much. It's not going to cut. It's certainly not going to hike anytime in the next few weeks. So I think here probably we're going to be ranging between maybe around about 4% on the top side and maybe down towards about 3.7%. So probably about a 25 to 30 basis point range here on the 2-year, and unless we get some kind of extraordinary news or geopolitical stuff or very very strange data. Now in terms of other stuff, it's going to be kind of difficult for the economy to rally sort of strongly, until and unless we get the tariff situation is resolved. And everyone's talking about, like I was reading this morning, European Union saying they're hoping to get a deal done by July the 9th. I mean, that's 48 hours away for a complete trade deal on European US trade, which to me seems sort of wildly optimistic. So I think the point is that we're going to have a lot of chop. There's going to be extensions, compromises. There's going to be confusion, probably going on for the next few weeks. And what happens? That takes us in the next few weeks. Let's say, for 8 weeks, we get the quarterly refunding announcement in about 3 or 4 weeks. And that's interesting because keep in mind that Trump has basically sort of threatened to no longer, so to force the Treasury or to instruct the Treasury to not issue long-term bonds. And that would be an extraordinary development, which we haven't seen for, I don't know, forever. I don't think Besant wants to do that. I think he's got to sort of circumvent that sort of in privately. But basically, the market will probably keep an eye on the weekly bond auction announcements. So if we just look at also what's happening here in the MOVE index, which is the volatility of bonds, you see that's going down. So what the bond market is saying here is that it's sort of waiting. It needs clarity for the tariff situation. It needs clarity about the Fed, and probably at this point it needs clarity about bond issuance. So the quarterly refunding announcement, we'll get maybe some signs of that on the weekly announcements. But really the big one is, as I say, the QRA. And if they were, which I think is very low probability, but if the Treasury were to announce that they were suspending the issuance of long-term bonds, that would be pretty incredible. So we have the key dates of July the 28th and July the 30th for the composition. Now, Trump definitely, they want the weighted average maturity to be shortened, because Trump is essentially saying he doesn't want to pay long-term interest rates, okay, and the Fed needs to cut. But if we were to get such an announcement, I mean, just very quickly, I mean, I think it's low probability, and we'll talk about it closer we get there, but we would get probably the 30-year. I mean, there'd be huge. The 30-year yield would probably collapse a good, 20 or 30 basis points, probably down to like 4.6 or something, if not more. It would get a yield curve would flatten very hard. We'd get a long and led bull sort of flatness. So it would probably get, this sort of flattening down very, very hard. Again, probably 20 or 30 basis points. Term premium would probably come down. Term premium at the moment, it's about 50 or 60 basis points. That would probably come down, maybe 15 or 20 basis points. Real yields would fall. The US dollar, which we can have a look at, we'll have a look at gold. Gold would rip no doubt into all-time highs. The US dollar would probably collapse. I don't know exactly where the US dollar would go down to, but certainly the US dollar would fall, several percent. And we'd have to assume that the equity market would rip, maybe 5 or 10%, similar to the US dollar, that kind of order of magnitude. So we're not there yet, but that's the kind of thing which the bond market really needs to know about, because that would be a huge deal. Again, I think the expected value on that is low, just because I think the probability is very low, but the potential outcome would be enormous. So just keeping in the bond space, just quickly, if we look over at Germany, you can see here on the 2-year yield on this daily chart, you can see that basically for the last 2 or 3 weeks, it's just gone sideways. Absolutely, sort of nothing's happening there, and that makes sense because the EU has cut. The ECB has cut relatively sort of significantly, and there's not much for them to do at the moment. They're waiting for more data. They've essentially said that they might be cutting. The market is saying they might be cutting in September or later in the year, but for the moment they're done. So the front end of the curve there is pretty much anchored. If we look at the 10-year, we always have in the background this idea of extra infrastructure spending, less fiscal discipline, spending on defense. So I think at this point we might have some kind of cap around about the 250, 251, 252 level here on the downside for the yields. And if anything, the pressure is always going to be sort of this to be floating up like a beach ball. So I think the pressure in Germany is more for a sort of a steepening kind of pressure. What is interesting is that if we look at something like the Italian yield, that just continues to be the one which is the sort of the heaviest in a sort of a positive sense, that it's going down all the time. Meloni is who the head of the prime minister, obviously, of Italy, is making all the right noises. The financial markets are enjoying the extra carry. Keep in mind here that the pickup between the Italian bond over the German bond is about 90 basis points, which as we know historically is very low. That's been historically 2.5%, 3% or so. So if you actually look here, Meloni's done an incredible job to kind of convince the financial markets that the fiscal house is in order, that spending is under control, that they're trying to reduce the debt. I've read a lot of research saying that that's not exactly the case. They're still issuing a lot of debt. It seems to me that there's still quite a lot of ECB bond purchases happening here, which is disproportionately favoring Italy. But nonetheless, that's the situation we're at. Having said all that, if I put this on, let's say, a weekly chart, you can see that this has been in a downtrend for I mean, depending which way you want to look, even sort of going back to 2022, but certainly the end of 2023, and we're now at a very key level, as I say, about plus 90 basis points in favor of the Italians. And if you go back, you can see that we're now getting to levels where the market hasn't really spent much time below here too much. Now, could this go down another 5 or 10 basis points? Yes, but I think the risk reward here of owning Italy over Germany, for sure there is a pickup for institutional players of, as I said, 90 basis points. But as that goes down to like 80, 70, 75 basis points down here, 60 basis points down at this level, you have to think that the risk reward for those institutions, or just the risk, becomes a little bit less attractive. So this is something I'm keeping an eye on. I think it wouldn't take much, any kind of crisis in Italy, any sign that the fiscal discipline is weakening in Italy, or any geopolitical crisis. I think definitely looking to sort of potentially sort of play this the opposite way at some point. We shall see. Okay, just going to grab some tea here. So as I say, in terms of what's going on today and what happened over the weekend, we had an OPEC Plus meeting at the weekend. So just bring up the oil chart here. Interestingly enough, if we look at oil, it didn't settle on Friday just because of the holiday at the WTI. But you can see here, oil actually has had a pretty positive price action here. It's hovering now around the 20, 50, 100 congruence of moving averages here, being supported by this sort of uptrend. And it looks as though it's going back into this trading range. You see this sort of pink box here, the pink rectangle here, which is above about $66. I thought it might go a little bit lower. Basically, if we look at what happened with OPEC Plus over the weekend, they agreed to boost their output by about what was it, 550,000 barrels a day. That was more or less expected. A number of 411,000 was expected, so it's a little higher than expected. There's sort of also sort of rumors and gossips and headlines basically saying that it's likely in September, so at the next meeting, for another 500,000 barrels a day. So if we wind all the way back to 2023, if you recall, OPEC Plus or the Big Eight sort of members, excuse me, they agreed to cut production by about 2.2 million barrels. So they're kind of bringing all that production back. They've done it for the last, what's this, the fourth meeting. It looks as though they're going to do it again for September at that meeting. And so they're bringing back their production a little bit sort of faster than expected. And you can say, well, why are they doing that? As I showed you, I think last Thursday or Friday, just a survey from the Dallas Fed, which is quite concentrated on the oil industry. They know that, especially let's say in the U.S., oil shale producers, with oil, at these prices, it's not bad for those producers. They're not going to reduce production. But if WTI were to get down, another $5-7 lower into the sort of the late 50s, mid 50s, early 50s, most of those sort of companies in the US in the shale patch would actually significantly reduce their production. So who knows? Maybe the Saudis and the others are saying, hey, we don't mind having a little bit of short-term pain in terms of the price. That's not happening at the moment. I mean, the prices are not super elevated, but they're not, down in the 40s and the 50s. Maybe, their priority is to get sort of more market share. And if that means that the price goes down a little bit with this extra production, maybe that's going to put some pressure on the production of the US. And ultimately, that would be good for OPEC Plus to sort of force them out of the market, get market share, and have the price up a little bit. We shall see. But if we just have a look, just look at the curve and whatnot, let's just look at a couple of metrics here for oil WTI. Let me just go back here. So just going to bring up two or three sort of charts here. Let me have a look. Yeah, so I'm just going to grab some more tea. If we look here, again, this is CL1, CL2, sort of front contract, so the spread. You can see that, on the news last night, it gapped down $1 or so at 6 p.m. last night on the open Sunday night. But basically, the spread is, it's not bad. It's a $1.42 premium. So, nothing sort of super dramatic. The market was pretty much sort of expecting that. If we look here and look at the curve, you can see that the curve here, yes, the price has come down, but if you look at the curve, it's still very much in a strong backwardation, a state of backwardation. So the front curve, you see here that the front of the curve is definitely trading with a very solid premium, well, a premium towards later on. So the curve is relatively healthy. And if you actually look at the statement from OPEC Plus over the weekend, they did say that they believed that global demand was solid, that there was no need for them to particularly, not be sort of underproducing at this point. We shall see. In terms of inventories, it is interesting. This is the US inventory. And if you look here, this is going back all the different years. This is a seasonal inventory. So if we look where we are now, which is this sort of pale, what is it, pale blue line, which I've highlighted, you can see that there. You can see here that we're down at this level. So here we are, July the 7th. So historically, at least if you look at the last 5 or 6 years, we're at, the lower end of the range in terms of the inventories. So maybe there isn't that much sort of physical oil out there. Globally, you read different things. I've read stuff saying the inventories are stable. I've read other stuff saying that inventories actually are rising a little bit. It's a little bit of an opaque market, especially in sort of China, India. It's difficult to know exactly. But certainly in the US, where the numbers are relatively accurate, you can see here that, as I say, inventories are seasonally at quite low levels. Definitely lower than they've been for the last 4 or 5 years, with the exception of 2023 was pretty low. And obviously COVID 2020, you see all the way up here, was ridiculously high. So that's interesting. Just keep an eye on oil. It looks as though the market is solid. I don't know exactly how one would play that. I think definitely sort of a pullback for me would be interesting, but it looks as though it's holding this trend. But at this point, as I say, if it breaks this trend line, which it seems to be holding at the moment, it could sort of fall down a little bit here. And also it's got all these moving averages. So it's going to be interesting to keep an eye on oil over the next few days. Just in terms of other commodities, we'll just have a quick look at gold here. Let's have a look at gold. Gold, again, we had the fib here. I'll break this down to a 4-hour chart. You can see here that listen, gold's done nothing wrong from a sort of on a daily chart. I mean, it's still an incredibly bullish sort of uptrend. But if we just look here, you can see this fib here. So just from this impulse from let's say Sunday, June the 15th, going down here, you can see here that it kind of failed at the 50% fib just on the 4 hours on the moving averages here, just sort of above that. So just sort of coming off a little bit. It could be because the US dollar is a little bit sort of stronger today. Again, this just looks to be like a sideways consolidation. Doesn't seem as though suddenly in some kind of, I don't know, downtrend or something, because the structural reasons, debasement of fiat currencies in general, central bank buying, potentially continuing sticky inflation, potentially. I mean, China, Switzerland, Europe doesn't have that. So talking about the US. And again, this is gold priced in US dollars, of course, not exactly the same thing as in euro, which we can have a quick look here. You see it's actually a bit weaker in euro. So some of this is definitely a US dollar situation. But at the moment, as long as the US dollar remains relatively weak and potentially going to weaken even more structurally, it's hard for me to see gold, collapsing. Now, could it come down to one of these levels, 100-day EMA? Sure. I will keep an eye on that. So just finally, guys, just want to have a quick look at the dollar and equities. If we have a quick look at the dollar, we can see that, again, very oversold. Just finding a little bit of support here. Again, finding it hard to break out of this sort of downtrend line, getting a little bit of support this morning. Let's see. I think it's all going to be dependent on what happens with the tariffs and trade, this week could be sort of choppy. I mean, of course, this little bounce, quite possibly was just coming out of that non-farm payrolls, which the market interpreted as being sort of better than normal, better than expected, rather. And if we just finally just have a look at the ES here, I mean, at this point, if you look at something like this they'll put on the SPX on the cash market, very, very, very strong. Kind of back test down to, something like down here, 6,100, 6,120, for sure it can. But if you look at this on a daily or a weekly, even a monthly chart, very, very, very strong chart. I mean, this is on your weekly. I don't know if we have the monthlies here. Let's have a look on the monthly chart. You can see this is a very, very bullish sort of pattern. So although there are sort of various people calling for, a recession, and eventually the tariffs are going to sort of cut people's ability to spend on stuff, and wages are slowing, and there's a lot of good reasons to support all that. But at this point, the chart has done absolutely nothing negative or bearish. And so I think the most we can sort of expect, at least in the next few days, absent data and absent any headline moving developments, is maybe just a retest back, towards these 6150 or whichever level, just back down here a little bit, because at this point it is very, very strong. So you'd have to be looking for fib extensions, maybe as resistance. You look at the ES here. I think I've got some fib extensions. I thought I had those. Are they maybe not coming up? There we go. Took a while to load. So you can see here, if you look at the various sort of timeframes and various fib extensions here, you can see that maybe some kind of technical resistance, overhead Bollinger Bands on the monthlies, for example, is an interesting one to look at. But at this point, the market, the most I think is a little retracement or maybe some sideways consolidation as we go through the summer. Because as you can see, just to finish off here, looking at the data, the point is that there isn't much data this week. Just looking at the US space here, just on the Bloomberg, you can see we've got tomorrow NFIB small business optimism survey. Okay, we've got Fed minutes, which could be interesting. That's on the 9th, so Wednesday. That's on a tariff day, so that's on the Wednesday. That could be interesting. And then we've got initial jobless claims, which all of us are sort of looking at the moment. But at the end of the day, there's nothing sort of massive here. I don't think there's even any Fed speakers particularly sort of booked in for the next day or two. Not too much anyway. So we'll have to probably just deal with headlines dominating everything. Okay, guys, I'll leave it there. Thank you very much. Have a great day, and we'll keep the conversation going during the week. Thank you.